What's up, my mind, your money business folks? It's me yet again with another video. I just got home from the gym, had a nice workout. Had a nice workout. So I just finished also finished my dinner. And so I was scrolling through the World Wide Web. And I was like, I wonder if there's something I could talk about. And I found this article that I find very interesting. The title alone caught my attention. I have yet to read it, so I'm going to do it now. And the title of this article is, "The stock market has done this only 3 times since January of 1871. So what is that thing that the stock market has only done 3 times? Since 1871. Again, the stock market has only done this 3 times since 1871. So let's get into it. It says, throughout the year, there have been an assortment of correlative events, forecasting tools, and data points that have warned of potential weakness in the U.S. economy and our stock market. This includes the first notable decline in U.S. M2 money supply since the Great Depression, the longest yield curve inversion in history, and the correlative performance of equities when the Federal Reserve shifts to a rate easing cycle. However, one historically flawless valuation metric stands head and shoulders above these other tools and is doing something right now that's only been observed 3 times in more than 150 years. What is it? Okay, most investors are probably familiar with or rely on the traditional price to earnings PE ratio, which divides a company's share price into its trailing 12-month earnings per share. The price to earnings ratio provides a relatively quick way to compare a company's valuation to its peers or the broader market. However, the traditional price to earning ratio also has limitations. Specifically, it doesn't work particularly well with growth stocks since it doesn't factor in future growth rates, and it can be easily disrupted by stock events, such as the lockdowns that occurred during the early stages of COVID-19. A considerably more encompassing valuation tool and the metric currently making tool is the S&P 500's Shiller PE ratio, also referred to as the cyclically adjusted price to earnings ratio, or CAPE, CAPE ratio. Okay, I never heard of that one. So let's keep going. The Shiller PE accounts for average inflation adjusted EPS. EPS, remember, EPS stands for earnings per share, from the previous 10 years, which smooths out the impact of stock events and allows for apples to apples valuation comparisons looking back more than 150 years. Okay, I guess it's going to take a while to get to these things. Okay, as of the closing bell on November 13th, the S&P 500 Shiller PE clocked in at 38.18, more than double its average reading of 17.17. When back tested in January of 1871. But more importantly, the Shiller PE ratio has reached a reading of 38 only 3 times during a bull market rally in 153 years. Interesting. See, that's why it's good to do research. In December of 1999, during the dot-com boom, the Shiller PE peaked at a reading of 44.19. Meanwhile, the first week of 2022, it very briefly lifted above 40. And the stock market did do pretty well in 2022. And that's when I mistakenly held back a little, which I shouldn't have. What's noteworthy is what's happening to Wall Street major stock indexes following these prior periods when valuations became very clear overextended to the upside. The dot-com bubble resulted in a peak to trough drop of 49% in the S&P 500 and a considerably steeper decline in the NASDAQ Composite. Meanwhile, the Dow Jones, S&P 500, and NASDAQ Composite entered respective bear markets in 2022. And that's when I slowed down when I shouldn't have. I should have been buying the dip, and I did not in 2022. But let's continue on. Stepping back even further, there have been only 6 instances since 1871 when the chiller PE surpassed 30, including the present. So is this saying we're about to enter a bull market? Remember, a bull strikes up, so that means the stock market is going to go up. Or a bear market. A bear strikes down when it attacks. That means stocks are going down. But I keep reading bull. Bull. So are we about to enter a bull market? Let's continue on. Okay, following each of the 5 prior occurrences, the Dow, S&P 500, and or NASDAQ Composite eventually fell between 20% and 89%. Although the chiller PE tells us nothing about when stock market corrections, bear markets might occur. Thus far, it has a flawless track record of foreshadowing major moves lower in the stock market. Interesting. This could be a warning saying we're about to enter into a bear market. Perspective changes everything on Wall Street. Based on what history tells us, at some point in the not too distant future, we're going to see a pretty sizable move lower in the Dow Jones Industrial Average, S&P 500, and NASDAQ Composite. But if you are a long-term investor looking to the horizon, history has a message for you and me, because I'm in it for the long term. Perspective changes everything. Over short time frames, predicting what the U.S. economy or stock market will do can be tricky, if not downright impossible. For example, recessions are a normal and inevitable part of the economic cycle. No matter how much we cross our fingers and think good thoughts, economic contradictions are eventually going to occur. But here's the thing about recessions. They're short-lived. Very true. When COVID hit, everything plummeted. I jumped in the stock market and I have been making gains ever since. So it says, if you take a step back and look at the bigger picture, you will see that 9 out of 12 recessions following World War II resolved in less than a year, while the remaining 3 failed to surpass 18 months in length. It's short-lived. Just like when you're serious about losing weight, it might have taken you 36 years to gain all of that weight. It could take you 1 good year or 2. Say it even takes you 3 years to lose all of the weight that you gained. It took you less years to lose it than it did to gain it. I don't know what that's supposed to mean. Either way, the recessions don't last that long. And the market eventually goes back up. Okay, on the other end of the spectrum, 2 economic expansions have reached the 10-year mark since World War II ended. The point being that the U.S. economy spends considerably more time in the sun than navigating through a storm. But you have to take a step back to see the dynamic play out. The same holds true on Wall Street. Interesting. Interesting. So he has a data sheet here in the article. And the data sheet, it shows that posted on social media platform X in June of 2023 by the researchers at Bespoke Investment Group. It shows the calendar day length of every bear and bull market in the benchmark S&P 500 dating back to the start of the Great Depression in September of 1929. And the average S&P 500 bear market decline is only 286 calendar days, roughly 9.5 months. This is consistent with downturns in the U.S. economy resolving quickly. There are always market corrections, people. On the other hand, the average S&P 500 bull market over 94 years has endured for 1,011 calendar days. That's like 3 years, right? Yeah, close to 3 years. Which equates to around, I should have kept reading, which equates to around 2 years and 9 months, including the current bull market rally. Just over 14 out of the 27 of all bull markets for the S&P have lasted longer than the lengthiest bear market. Even though stock market downturns are normal and inevitable, perspective demonstrates just how powerful patience can be for long-term investors. And I am a long-term investor, and I am very patient. Very patient. So don't miss the second chance at a potentially lucrative opportunity. Ever feel like you missed the boat in buying the most successful stocks? Then you'll want to hear this. On rare occasions, our expert team of analysis issues a double down stock recommendations. But I'm not going to go through all this. It just talks about if you had invested $1,000 in Amazon in 2010, you have about $22,000. If you invested $1,000 in Apple back in 2008, you'd have about $42,000. And if you had invested $1,000 in Netflix back in 2004, you would have over $444,000. Yeah. But yeah, that's pretty much it. So pretty much it sounds like there's a downturn that may possibly happen. For some strange reason, I was expecting the article to say more. So a downturn may happen. But what it says, pretty much what they're saying, because of the score, that 38.18 that the S&P got to earlier this year, history has shown us afterwards there's a market correction. And that 38 points was like, they call it the chiller P&E ratio, price per earning ratio. So it was pretty high. So maybe next year there's a market correction. And if that happens, for long-term investors, what the article is saying, be patient. You can't time the market, just be in the market. I say that a lot as well. You can't time it, just be in it. Continue to dollar cost average. Have money set aside in your emergency fund. Become debt free. Emergency funds. So when there is a downturn in the market and you are investing, you can invest more money into the stock market because you have little to no debt. You're able to do whatever you want to do with your money, and that is what I will do if and when this downturn happens. I thought it was going to be all positive, but I guess it is positive. It's not, I guess, it is positive. It's just telling you what to do when this happens. There's a correction. It's normal. Just continue to invest. Be patient. In less than a year, the market can return or normally returns back to normal. And because of this information technology boom, I can see a correction happening and then things just skyrocket after that. Yeah. All right, so that's it. I'm actually going to finish this little drink here and then go for a little evening stroll. And then come back home and wake up and see what the market is like in the morning. All right, so you guys take care. Like, comment, subscribe, share this video. Let me know what you think, if you think anything at all. Also, disclaimer, I am not a financial advisor. All the content, information that I provide on this channel and in these videos are for entertainment purposes only and reflects my opinions. So please consult with a financial advisor before you invest any of your money. But invest nonetheless. All right, so you guys take care. Peace.